As we've told you previously, the USDA is projecting net cash and net farm income to fall in 2016, this time for the third year in a row. Net farm income is expected to be less than half the record farmers set in 2013 and off 3% from 2015. Earlier this week, we talked with Tina Barrett about tax changes farmers and ranchers should be aware of, and we began by talking about the current environment with lower incomes, but not necessarily lower tax bills.
Well, you know, tax planning kind of is not what most people are thinking about right after March 1st, but it's certainly time to think about things and some of the bigger changes that are happening. But what we're seeing from a production standpoint is lower incomes, and what we're seeing from a tax planning standpoint is maybe not yet, because there was so much income that was made between 2005 and 2012 that hasn't been paid tax on yet. And so we've got to keep that in mind, that we're not ready to start lowering those tax bills dramatically for most producers, because the only real way to do that without paying taxes is to lose a lot of money. So hopefully we're not seeing those negative incomes, and that we're still needing to manage that tax bill.
Overall, though, you do believe incomes in 2016 will be lower?
It's sure, well, you know, lower compared to 3 or 4 years ago. You know, will it be similar to 15? Maybe. You know, I think we got a lot to see. You know, 15 we ended up with excellent yields. So, you know, if we end up with average yields, 16 will be a little bit less. You know, we don't know for sure what pricing opportunities we have. And it looks like, you know, the ARC payment is going to be about the same. So, you know, at this point we're kind of planning 15 or 16 to be about what 15 was, but certainly nothing like what we had experienced 5 years ago.
Let's talk about some specific things within taxes, starting with Section 179. Now, there have been some changes. Where are we?
Yeah, so finally we can plan on this. So for several years we've been waiting for an extender bill in December to get us, you know, what we wanted to hear. So last December they gave us permanent 179 at $500,000 of expense election, again, the purchase limit. So if you spend more than $2 million, you start to lose that. But for most producers, that fits. We have that permanent, and it's indexed for inflation in $10,000 increments. So it'll probably take a few years before we see that $500,000 change, but it will change over time for us.
But there's a bonus change as well?
Right. So we got permanent 179 and the bonus depreciation, which both allow us to write off assets in the first year of purchase, but in different ways. That bonus they decided to go ahead and phase down. And so we have 50% bonus, again, for 16 and 17, 40% for 18, 30% for 19, and then gone. For most producers, that 179 is enough, and we're going to be good there. The big difference between the two is with bonus, we can write off part of that machine shed, those ag buildings. So for anybody who's thinking about putting up one of those buildings, probably the next couple of years from a tax standpoint is the time to do it. It might not be the right time from a management standpoint, though.
What's the deadline change to remember for next year? Okay,
so they early in 15 they made some changes to the filing deadlines for the 2016 tax return. So this is what we're going to be filing a year from now. And they moved the corporate tax deadlines for C corporations from March 15th to April 15th, and moved the partnership deadlines from April 15th to March 15th. All in, you know, wanted to get those flow-through entities due and done before we needed to file the individual returns. So a good change, but it is going to be different. Certainly going to affect the way your tax office works and the workflow that we experience. So they just might be wanting some information at a different time.
You said for C, this is a small portion of people you said it might affect, but for C Corp and S Corps, there's also something to keep in mind.
Right. So there's when you switch from a C Corp to an S Corp, there's a holding period, and it's been 10 years. And probably for the last 10 years, they said sometimes, well, if you did it 7 years ago, you're good, and if you did it 5 years ago, you're good. And we've never been able to plan that. And in December with that tax extender bill, they gave us a 5-year permanent limit there. So for those corporations that have that land sitting in it that we're trying to get out, when switching over to S Corps, got a 5-year holding period, and if you're involved in that, you know exactly what I'm talking about, and if you don't, then that's okay. You can just ignore that.
Okay, can do, Tina. Supplies under $2,500 written off without question. Tell me what it means.
Right. So November, a couple of years ago, they gave us new repair regs, which seems funny to me because it doesn't affect repairs; it affects supplies. But they said $500, which we kind of looked at and went, $500, nothing on the farm is bought for less than $500, just forget it. In November, they said, okay, that was silly, let's make it $2,500. So any supply that you purchase up to $2,500, we can write off as a supply. Don't need to capitalize that item. So we're probably talking about things like welders and generators and those smaller items that we're always, do we capitalize or not? But a couple cautions there that we're seeing as we start to get into this. We need to establish a business practice for wherever up to $2,500 that you want to do. But anything item that you buy then that's under that limit becomes a supply. So one of the first ones we thought of that this could cause a problem for is cow-calf producers who are buying heifers that their per item limit is usually under 25 or back under 2,500 now. And so that would mean we could call all of those cows supplies. I'm not sure that's the right choice when we're talking about, especially when we're buying cows and borrowing money for them and making payments later. It also means that when you sell those items, we have ordinary income to recognize. And that's not the tax treatment that we get from cows right now. And so there's some long-term solutions. So you really want to make sure that before your tax repair is just mindlessly electing this de minimis repair reg that we take into effect. And you can choose the $1,000 limit for your operation if you want to. And so anywhere in there. So something certainly to talk about with your tax repair and what's right for you. We also did just get word from the state of Nebraska that they're going to follow that. So that generator that would have been a personal property tax item, and then now we're going to call a supply, doesn't need to be on your personal property tax return either.